Okay, so for anyone who doesn't know, my name is Faith Jonkman, and I am a financial security advisor and investment dealing representative. I work with Freedom 55 Financial, which is a part of Canada Life. So I graduated in 2019 from Carleton University with a degree in international business, concentrating in global finance. And so what I do is I build personalized individual financial plans to help people achieve financial independence and meet all of their goals. And how I play into the tax clinic is that I work a lot with minimizing your taxes. And as most of you are going to be working in a few years, it's definitely something to think about, because that is going to be a major thing in a few years for most of you. So I'm going to throw out my PowerPoint here, and seeing as we're talking about a lot about taxes today, there are only 4 things in Canada they earn money on that will not ever be taxed. Does anyone know what any of the 4 things are? Either put them in the chat, unmute yourself. I don't even know if I can see the chat. But anyways, the 4 things that you'll never have to pay taxes on in your life are on your principal residence. So if you sell the home that you live in, you don't have to pay taxes on that. Your tax-free savings account, that will always be tax-free. Your, if you get a life insurance payout, that will be tax-free. And the last one is if you win the lottery. So as an advisor, I can help you with 3 of the 4 of those things, and the other one is up to chance. So we'll walk through some of those things today and how you're able to achieve those and minimize your taxes. So we're going to talk today about how to invest efficiently and the best ways to do it and what to know to set those things up. If there's any questions going through about what I'm talking about, if it doesn't make sense, feel free to unmute yourself or type it somewhere. And there's no sense of us talking about something if we are confused. So we're going to go over today the basics of investing, how to begin, what to know about beforehand, the different types of accounts that you can own, and then within those accounts, how each different asset is taxed, and then how to build yourself a plan and how to protect that plan. So before we begin investing, there are a few priorities that need to be addressed and make sure that they're taken care of. The first one is to pay off any of your high interest debts. That will be your credit cards, which has about a 20% interest on, your OSAP loans, which are 6.5% interest, and then any other loan from the bank, usually between 6 to 8% interest on that. So there really isn't a sense in investing to try to make 5 or 10% when you're paying something that is also worth 20%. You're still losing money in the long run. So pay off those high interest debts so that you can start building your money fast. The second one I cannot stress enough is to have an emergency fund. And this is between 3 to 6 months of your monthly expenses set aside in the case of an emergency. And last year is a prime example of that, where people were laid off work and there won't always be government stimulus out there to assist and help get you through those times. So having an emergency fund, important to have set aside in a high interest savings account at the bank before you begin investing. Then to create yourself a budget and set goals for yourself. See how much money you make versus what your expenses are versus what you're planning to do. So once you know what you're trying to do, you can work towards that. So set those goals out of personal, professional, short-term, medium, long-term goals so that you can work towards each one and make sure that they're coordinated so that one goal is leading to the next one happening in the next phase of your life. And then finally, to educate yourself on investing, which is what we are all here also doing today. So now that we've got the basics covered of what we need to do beforehand, the first thing to look at when you want to start saving is what type of account do we want to open? There are a bunch of different types. First gets broken down into, is it a registered account or is it a non-registered account? So a registered account is linked through the government in the CRA with your tax returns and your social insurance number. And those are your tax-free savings account, your retirement savings plan, an education savings plan, which is saving for children in their youth so that they can have money set aside for school. And a disability savings plan is saving for someone with a disability so that they have money later in their life. Those are the only registered types. And then basically anything else is going to be considered a non-registered investment in a non-registered or open account. So these are going to be your high interest savings accounts at the bank. They're not under that tax sheltered umbrella. Any cryptocurrencies also all need to be held in non-registered accounts. They are not considered an asset class that's acceptable within a registered account, so they need to be held outside. And then all other investments that you can't fit inside these accounts are all going to be in your non-registered. And so these both have different tax consequences that are associated with them. So we'll run through the most popular ones that we will have open at some point in our life, and they're the most beneficial when it comes to tax savings. So the first is sheltering your growth with your registered retirement savings plan. These were created by the federal government in 1957 as part of the Income Tax Act. And so what this does is it allows you to contribute 18% of the income that you have made since you're 18, and it's the income that you have filed on your taxes. That you take 18% of it, and that's how much money you can put into your RSP, and it gets carried forward every year, and you can put in up to that maximum. So what happens when you put money into here is that you're going to get a tax refund on your contributions based on the taxes that you paid on that money you put in. Then once you get your money back and the money's in the account, it's going to grow on a tax deferred basis. So you're not going to have to pay the annual capital gains on that until you withdraw it from the account. Then it is taxed as income then, because the income tax had already been taken off of it previously on the refund. And so the point of this is to put money in when you're in a higher tax bracket, so you get all this savings, and then when you're 65, 70 and you're going to take this out, you're in a much lower tax bracket because you're no longer working. So that's when you're going to want to withdraw the money out of there to get the most tax savings off of that. And because it's a registered plan, you are allowed to name a beneficiary. So that means that it will never flow through your estate. The next type of plan there, oh no, we're still on the RSP here, sorry. These are the tax brackets for 2021 here in Canada. The left has the federal portion and the right is the Ontario portion. So you add those two together to find out what tax bracket you will fall into. And every person has a level of tax exempt income here. So for 2020, the first $13,229 that you make are tax-free. And then after that, you get into the first bracket where you're charged about a 20% when you put it together. So as an example for the Rsp deductions on that is that, say you made $40,000 and the taxes based on the chart above are about $5,000. You're now able to contribute 18% of what you made, which is $7,200. So if you contribute that, you will get a refund back of over $2,000, which you can then say put towards next year's RSPs, or you can save it in another account or put it towards whatever your goals are. Then the other thing to point out with an RSP is that the government allows you to take out money tax-free if you use it as a down payment on your house for the first time that you purchase a home. They allow you to withdraw up to $35,000. That's paid back over 15 years, and it's basically like a loan from you to yourself. So that is everything to do with the basics of a registered retirement savings plan. The next registered account will be your tax-free savings account. This one was created in 2009. And so what it is basically, it's been about $5,000 of contribution room every year since 2009. This year is $6,000 worth of room, and that will accumulate since you turn 18. So you have however old you are from 18 times about 5,000 or 6,000. That's how much room you can contribute into your tax-free savings account. So why you want to contribute into your tax-free savings account, you're not going to get a refund like you did on your RSPs there. However, there's going to be no tax on any of the growth within the account, even when you withdraw it. So it's a completely tax-free way of growing your money. And as well, you can have a named beneficiary so that the money would never flow through your estate. Those are the two main registered plans that we use the most frequently. And then anything else is going to be in a non-registered account. So this is going to get you no special tax treatment. And you want to use that after, say you've maxed out your RSP and your tax-free savings account. That's when you're going to look into using a non-registered account to hold your investments. It's the least efficient. That way, again, you'll need that to hold any cryptocurrencies. And if you are day trading, you need to use a non-registered account because you aren't allowed to day trade within your tax-free savings account. You will get red flagged and you will have to pay your taxes from within your tax-free savings account if you are caught doing that. So that's a heads up on that one. And then each different type of asset that you now hold in these accounts are going to be taxed differently. So when you earn income, you're going to be taxed at your marginal tax rate. However, if you are holding a bank account or you have GICs, bonds, you're going to be earning interest on those. And that interest is then going to be taxed at your marginal tax rate. This is the least efficient type of tax. You're going to pay the most tax on interest income. The next one down is your capital gains. So these are the gain or loss that you arise from the sale of an investment. So if you sell your investment, you make money, you're going to have capital gains on a stock. And these have slightly special tax treatment in the fact that you're only going to get taxed on half of the gains that you make. So there's an inclusion rate of 50%. So you pay tax on half. Then the third one is dividends, which you'll get from owning an individual stock. And those are a share of the company's profits. They give out quarterly or annual dividends on their stock. And the math on that one is a little bit more confusing simply because the company has already paid taxes on this money. So you have to, the calculation is accounting for their taxes and still making you pay for a portion as well. So it gets grossed up 38%, and then you get taxed at 15%. So that ends up being about, you pay about 20% in taxes on dividends that you earn. And that's if they're not held in a registered account. This is how they're going to be treated. If you have them in your tax-free savings account, then you're going to pay zero for all of these. So that's the benefit of utilizing the accounts. This is once you have maxed that out or you're not holding it within. And this is for my entrepreneurs and business owners out there, that if you own a share of a small business, whether that be like family business or farm or a fishing property, and you sell that, you don't have to pay taxes on the capital gains because it was a business. And everyone is entitled to a maximum of $892,000 of this exemption in their lifetime. So a thought for business owners on that one. And that is all of the different types of accounts and taxation that you will receive. And so now how do I do this? How do I set up my own plan? How do I choose which account I should open first? Should I open a tax-free savings account or an RSP first? Should I be riskier and be in stocks, or should I be more focused on fixed income? And how you think about this is a lot of different things coming together. And so as an advisor, how we do this to help you achieve that is we look at 4 different cornerstones. We look at your cash flow, how much money you have coming in and out, income protection, protecting you, your retirement plan, and then any estate planning. So how we do that when it comes to your cash flow is looking at what comes in and what comes out of your account. Are you spending within your means, and are you saving beforehand and making it a priority? If you set a specific level that you want to save each month, you are going to be more diligent on actually saving that first and then spending your money, like person B, as opposed to spending your money that you got and then saving what you have left at the end of the month. You're never going to be saving as much as you're going to want to be, and you don't know if you're going to be hitting your goals and being on track to hit your goals if you're not paying attention to it. And unfortunately for us, there are a few reasons as to why we must be more diligent on that. And those are because people are living longer now, and there's 30 years after you retire that most people are living. You need to be able to cover your expenses for 30 years after retirement. And a lot of companies aren't providing a pension anymore. So the only time you're going to be able to find a pension is if you have a good government job, or you're part of a union, or the odd company will have a contribution plan, but you need to be focusing on that for yourself instead now. A lot of people are wanting to retire earlier now. I don't know about you, but I see YouTube videos that pop up of retire at 35 a millionaire. Okay, that's an ambitious goal, but how are you going to get there? You need to map out those next 10 years are crucial for you to get to that point. It is achievable, but there needs to be an outline of how you're getting there. And the last one I threw in there is that the prices of homes have increased, and we think we're in a housing bubble right now, but you never really know if you're in a bubble until the bubble has popped. But we know that the costs have increased substantially over not even just the last year, the last 5 years, things have doubled in price. So you got to be saving and paying more attention to that so you can hopefully eventually one day own a home and have enough set for a down payment for that. That's your cash flow. And then now that we've worked really hard and we've saved up all this money, we want to protect ourselves and never have anything disrupt our plan, because there are things that will come up in life that have the ability to completely derail your plan, and they will come up. However, being prepared for some of the things is important. And so the greatest asset that you have is actually your ability to earn income. If you think of how much you make a year times 40 years, that's a lot more than your car is worth. It's a lot more than your home is worth. You need to be able to go to work so that you can buy all of those things. So if you're not able to go to work, how are you doing everything else and funding everything else, right? So you have a car, you have car insurance, not just because the fact that they make you have car insurance, but because your car gets you to work every day. And you live in your home, you have house insurance on that, because what would you do in the case of an accident or something happening to your home? And then you have a job. Do you have insurance on the fact that you can go to work? Because I'll put the percentages up here and you can see how the percent of claims in each of these is car insurances get claims about 3% of them. Only 1% of home insurances will ever submit a claim, but 1 in 4 people will submit a disability and be off work for an extended period of time in their life. And like, some of them are permanent things. Some of them you can go back to work in a couple of years, a couple of months, but you need your emergency fund, hence why we have that for this exact reason. And it just is protecting your plan. And to go even further than that one, there is that 1 in 2 men and 1 in 2.2 women in Canada will develop cancer in their lifetime. And everyone can speak from experience of someone they know, the emotional and physical toll that takes, as well as the financial strain that causes. And if you can help eliminate one of those things that you don't have to worry about, and don't have to stress about money in that situation, it can be really beneficial to everyone involved. So that is the keys on helping protect yourself and your family and your plan. Then we shift gears onto the next cornerstone of planning for your retirement, and how the effects of compounding have such a drastic difference on the amount of money that you can make over the long run. If you see the dark green line there, is someone who has contributed $1,000 a year for 40 years, and for a total of $40,000. And the second person in the light green line there, they started halfway through and then contributed twice as much. However, you can see that the first person has over tripled their money on a 5% annual interest, and the second person has not even doubled yet. And that is due to the effects of compounding and starting now to get that exponential growth. Compounding is the idea that, say you invest $100 this year at 5%. At the end of the year, you're going to have $105. Now, next year, you're getting 5% on the $105 now. Now, at the end of the year 2, you have $111. So you get more and more and more, and it ends up snowballing into that big curve you see on the screen going higher upwards. So is definitely start saving at an earlier age, and you will really see the effects of that in the future and in your retirement. And so unfortunately, even when you do pass, you still have to pay taxes on your estate. So that's another reason why we as advisors look at estate planning, is because when you die, everything is a deemed disposition that you own. So everything you have is technically sold, your home and any investments. And those add up to be the value of your estate. Anything in a registered account with a beneficiary, it won't flow through the estate. So benefits of why we use those registered plans as well is keeping money out of the estate so that you don't have to pay taxes further on the money. And the fees associated with that then are the value of your estate. You're going to be charged probate fees and executor fees. The probate fees, first $50,000 is tax-free, and then anything above $50,000 has a 1.5% tax. That one goes to the government. And then the executor fee is who is in charge of speaking on their behalf and divvying up the estate according to the will. And they can charge anywhere between 1% to 5%. If it's a family member, they'll usually go for a lower fee on the lower range of that. But if you have a legal representative doing this, they're going to charge you the full amount, and especially if it's more difficult. So with that being said, your estate is getting charged 6.5%. And if you think about it, an estate worth $500,000, the family is now going to be charged with a $30,000 tax bill next year that they have to pay. And as an advisor, I can make that number zero, but that only works if you properly and preemptively plan. You can totally eliminate that quite easily. And so that takes you full circle in how we assess your situation to figure out what you need and where you should go and where you should put your money to be the most tax advantageous, because taxes really do add up and affect your wealth over the long run. So what are your takeaways from today, and where are you going from here? What should you do next? My recommendations for you, if you want to take a picture of this if you would like, is to start right now and write down a list of your goals, personal and professional. Where do you see yourself in 2 years from now, in 5 years from now, 20, 40? What's retirement going to look like? Because all of those different stages are going to look so different for every person, personally and professionally. And once you have that written down, you know how much money is that going to cost you to retire and buy an RV, retire and buy a timeshare condo in Florida. Like, that's what you need to start working towards now. And then when you get a nice paying job, then we look at starting a budget and starting those savings. And so create your budget. Even if you're looking at it now, start now so you figure things out and track how much you're spending, say, each month on food versus groceries versus takeout, going out to the bar. Those all add up, and you can really actually see what you're spending your money on and where your priorities really do lie. Set up your emergency fund with 3 to 6 months of your monthly expenses. That will change depending on, if you have a house or not. In a couple of years, you might want to have more in your emergency fund because you got mortgage payments and bills, more bills to pay that way. There's just different expenses. go ahead and use those registered plans that we talked about today. Open up your tax-free savings account, open up your RSPs later, and then within those accounts, diversify your assets. Have a little bit in every asset allocation, because you don't know what's going to be the next boom and the next crash in the market. Have some real estate, some sector specific, fixed income, equities, a little bit of everything. And don't be afraid to ask for help. I spit out a lot of numbers today, and I don't expect any of you to remember all those numbers or know them when the time comes that you will need to use them. So that's my job. That's what I'm here to do. And all us other advisors are there when you have a question about something that you want guidance on making your own personal plan. That's what we're here for. That's what we do, and help you set up everything that we talked about today. And so the big key moments to reach out and talk with someone is when, say, you're getting married, you have two incomes, two expenses coming together. When you're expecting a baby, you have new responsibilities and new expenses that also come along with that. Buying a house, the biggest financial decision in your life. It's best to have someone in your corner working for you, and the new change to your budget that's going to come with that. And as well, when you start a new job, that can increase or decrease your income throughout your life. So to reassess and rediscuss things, that's also a really good time to sit down with someone and chat about that. And so that is actually all I have for you guys today for my presentation, but I am open to answering some of your questions. If you want to unmute yourself, anything we talked about or anything we didn't talk about,